For more on the markets as we count down to the CPI inflation data, I want to bring in Brenda Vingiello, Chief Investment Officer at Hill Global Advisors, CNBC contributor. We are, what are we on, December 11th. So we don't have many days, like 20 days, basically, for the rest of the year. Where do we land? And maybe I should ask you, where do we land a year from now?
Yeah, so not much time to go, but we do think that here and now there is a lot of, we feel that we're in a honeymoon period following the election. Now, maybe not on the large cap side, as Rick Santoli was just talking about, but in other areas of the market, certainly are seeing that there is continued signs of optimism. So we think it's in investors' best interest to probably regroup and trim a little bit of exposure here. I think we might see more of that in the new year when clients can avoid a tax hit in 2024 and move that into 2025. But I think getting ahead of that for those that can makes a lot of sense. As we look to next year, I think we could have a more normalized return year, although there are a lot of things to focus on. One is on the corporate earnings side, where we think we absolutely need to see another strong year of earnings growth in order to see more appreciation in large cap stocks in particular. But then we also need to have clarification on a lot of things on the policy side that are still unknowns that could have an impact on the economy. And Trump is really, based on his cabinet picks, trying to disrupt a lot of parts of government, which you could argue is needed. We need to have more efficiencies, but it could be a lot all at once, which could also be somewhat disruptive. So Our view is that there's likely to be more volatility next year. Maybe we get a 5 to 8% return. But it's important to remember what that feels like, because when you've been up and to the right for as long as we have been here, it could be pretty jarring to see a bigger pickup in volatility.
Brenda, we're all waiting to hear what the president is ultimately going to do and what Congress will do with him. I think part of the job of any great investor is to try, for better or worse, to predict what he's going to do and get ahead of it. Mm-hmm. So when you think about sort of the big items on the list that you were just describing, which way are you betting, or are you trying to suggest that you shouldn't even try?
Well, it's our view that when we think about Trump's style, he loves to shock with these big statements. But when it actually comes to reality, I don't think his intention is to leave a legacy of having harmed the U.S. economy. So I do think we'll likely see things in a more rolled out in a more measured way. But in that being said, if we look at the economy today, though, it's quite healthy. We are in the midst of two potentially transformative growth drivers with artificial intelligence and GLP-1 drugs. So there certainly are reasons to be positive. So we think it's not in investors' best interest to become too cautious, assuming that policy is really going to have a huge detrimental impact, but rather focus on the fundamentals of the economy, the fundamentals of corporate earnings, and position accordingly. And in our view, that means being slightly overweight equity. We think there's more opportunity on the small and mid-cap side, which really haven't participated as much, that would be beneficiaries if we did see deregulation, lower corporate taxes, and ongoing health in the U.S. economy.